heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
We are live from London for the Bloomberg Technology Summit. I'm Caroline Hyde, and this is Bloomberg Technology. Coming up on the program, we'll speak to a range of UK-based tech entrepreneurs to discuss everything from venture capital, fintech, cybersecurity, and so much more. Plus, China rattles foreign firms again as it opens an investigation into one of Apple's most critical suppliers, Foxconn. Details ahead. Plus, we go back to the picket line as Hollywood studios return to negotiations with actors this week to end the months-long strike. But first, a check-in on those markets. And boy, has there been some volatility, particularly in treasuries. Abigail Doolittle, what's the read across here?
Well, there's been tremendous volatility at the surface level, Caroline. So much so, let's actually start beneath the surface, because if we had been looking at this board an hour and a half ago, there would have been at least some red on it. But we've had a flip to the upside. Microsoft and Meta, two of the mega cap companies, mega cap tech companies that are reporting this week, Microsoft tomorrow and Meta on Wednesday. A big piece of this turnaround for sure from a micro standpoint, and for Microsoft, one of the keys could be their outlook for Azure. That cloud business was a little bit disappointing. Plus, color on AI. For Meta, it will be all about whether or not they can maintain mid-teens growth. That could have a lot to do with pricing. We also have Bitcoin in rally mode, up 7 over the last 9 days. That is helping out Riot Platforms, up 10.2%, and NVIDIA receiving some favorable commentary from a Wall Street investment bank. Now, let's put this together with the NASDAQ 100 and see what it means. Here's this roller coaster ride. Now, to your point, at the lows, it was more of a macro story, Caroline. The fact that you had that 10-year yield back above 5% following the 2-year yield, the whole yield curve really flattening out. That, of course, makes stocks look more expensive. But big cap tech, in particular, that growth, the liquidity, it tightens the situation overall. But as the 10-year yields slip back to 490, take a look at the rally we have, plus some of those individual movers we were just taking a look at. Now, on the year, it's very interesting because over the last 3 months, we've had stocks down. The S&P 500 down about 8%. So on the year, up about 10%. The NASDAQ 100 at one point up more than 40%. So about 10% or so, very roughly, coming off of both of these indexes. You can see, though, that the mega cap tech indexes that have some of these stocks that are reporting this week up much more. What makes this interesting, Caroline, if we go into the Bloomberg terminal, it means that the S&P 500 is doing something that the NASDAQ 100 is not doing. The Russell 2000 led it, but the S&P 500 on the day was firmly below the 200-day moving average, back above. It looks like we're probably going to see some more weakness to the downside. The question is, will the NASDAQ 100, these big cap tech names, fall at some point? It could have just as much to do with yields as it could with earnings this week and next.
Macro, charts, tech, you do it all, Abigail. We thank you. Meanwhile, of course, a key corporate story of the day has been Chinese authorities, again, shaking the confidence of foreign companies in particular. That's with a series of arrests across industries and an investigation into the all-important tech name that is Foxconn. It's a key supplier to Apple, of course. And for more, we want to really dig into this narrative. Riva Goujon's with us, director at the Rhodium Group. And really, your expertise here, Riva, is so important. You advise, of course, within China. And I'm interested as to whether you think this is an ongoing pushback because of, well, the tech issues that we've seen, the rivalry between US and China, or is it something different entirely?
Well, lots of layers of intrigue here, of course. Now, any multinational corporation operating in China knows that there is always the risk of tax and compliance audits. This runs from technology to retail, really across the gamut. But in this geopolitical climate, of course, whenever these moves are taken, there's always the question of whether there's more of a political tinge here of economic coercion. And of course, Foxconn being so closely tied to Apple, is more of a question mark here in terms of targeting. There have been rumors of informal bans against Apple products. This comes in the wake of revelations around Huawei's breakthrough, making it a more formidable competitor to Apple as well. So lots of different things to untangle here. Other companies also facing crackdowns from China's data security laws. But there's a bit more to unpack here on whether this is truly a case for coercion and how it could tie into the Taiwanese election as well.
Yeah, let's dig into that in a moment. Hyde Precision Industry, it's the public arm of Foxconn, basically saying they will collaborate with authorities. And indeed, you mentioned this is in some ways to do with reviewing of land use and in particular tax audits. Tell us a little bit more about the added complexity that the founder of Foxconn, or Hyde, has stepped down, of course, because he's running for the Taiwanese election.
He is, and of course that it changes up the race a bit. He's running as an independent, and this is a very complex electoral dynamic for Beijing in trying to favor an outcome for the KMT, which is more friendly to mainland policies. It's hard to conclude, though, that a move against Foxconn would translate into a political favorability toward Beijing when it comes to the upcoming Taiwan election in January. There's a question of whether Terry Gou, his participation in the race would divide the opposition vote in a way that undermines the KMT, favors the DPP, which Beijing would not like to win. But still, that's a very complex logic chain, and I doubt that these moves against Foxconn would translate into Terry Gou actually pulling back from the race. So again, I think there's a temptation to see everything as a highly politicized move. But here, I think we need to take a closer look at Apple's diversification moves, other electronics companies and their diversification moves. China, of course, has a very big impulse now to strike back at U.S.-led technology and investment controls. We just had another round of U.S.-led chip controls, which is putting a lot of pressure on major U.S. tech partners to include Taiwan. So that is really, I think, the hypothesis to test here.
When you put, of course, you say it's easy to go for the highly political lens, go for the highly economic lens, because all of this comes in a much tougher context for China more broadly.
Absolutely. So anything perceived as retribution are falling into the scope of tightening laws around counter-espionage and countering any type of perceived espionage activity, crackdowns around data security in general. Multinational corporations are already on high alert, and this certainly doesn't help the souring investment climate. As we've already seen, FDI inflows into China have been leveling off, particularly since 2019. That's been very worrying, to the point where you see the State Council of China putting out all kinds of pledges to say it's okay, we're doing things to promote foreign investment, to include very notable things like easing cross-border flows in data regulations, a big ask for many of these companies. At the same time, every time that the U.S. engages in another round of technology and investment controls, there is this impulse to strike back. And you're seeing this through landmark legislation coming out of China, everything from counter-espionage law, the foreign relations law. It's a form of codifying retribution. And so as we start to see things translate into actions, for example, MOFCOM export controls on artificial and natural graphite. Artificial graphite is a very critical input for EV batteries. We've seen recent restrictions on gallium and germanium exports. Those are important for semiconductor manufacturing. And so all of this only underscores the unreliability of China in these critical value chains. And so that can energize diversification moves. But of course, China's looking to show where it can create pain in the here and now.
And it inflicts pain on its own publicly traded companies. I'm looking at the Star 50 index, which was only conceived of about 3 years ago to really try and be the rival, the Chinese version of the NASDAQ 100, and it's hit a record low since its inception. We are worried about growth concerns. We're worried about global liquidity and a weak export outlook, not to mention some of these political elements to it all. So go back to what you advise clients in the here and now, Riva. Of course, you are someone who lead client engagement for Rhodium's China Corporate Advisory. If I'm about to think about entering the country, do you say I wouldn't?
Well, it depends on where you are, which value chain we're speaking of. Even as diversification is happening, you can look at Apple, for example. You can even look at Foxconn's footprint and how it has a notable presence in China, but emerging presence in places like India, Mexico, Vietnam. So that trend is happening, of course, but these companies are also greatly exposed, Apple in particular. And as these companies are engaged in this balancing act, it is very important to understand the intent behind China's policy moves. It's caught between trying to promote a healthier foreign investment climate to counteract the forces of its structural economic downturn. And, that is something that is going to last for a while. At the same time, to stay alert to U.S.-led and partner moves on technology and investment controls, this is a fast-evolving space. There is a lot packed into for example, the 400-some pages of controls that came out just last week from the U.S. that is making it very hard for technology companies in particular at the leading edge to continue operating in China. You only have to look at a company like Samsung, for example, to see how actively they are diversifying outside of China already. So lots of moves in play. Balancing acts are hard to pull off in this geopolitical climate, but really depends on where you have a credible competitor in the Chinese space, where you're at the leading edge, and where other opportunities lie outside of China.
Such complexity, and you help break it down. Thank you, Riva Gujan of the Rhodium Group, for her expertise. The Bloomberg Technology Summit is going to kick off tomorrow right here in London, showcasing a whole range of startups, maybe in the biotech field, the healthcare standouts, for example, during a series of discussions about the UK's global role in the most pressing questions in technology today, whether it be climate change, whether it be AI as well. And in fact, just in a few weeks, the UK government plans to convene hundreds of international financiers, executives, of course, government leaders to promote, well, some investing opportunities in British companies, including those working on nuclear fusion, on deep tech, but most notably thinking about how AI safety can be deeped and seeped into the global narrative right now. Let's dive deeper into the world of the tech scene here in the UK with a standout startup. Philip Bellamont's the leader, the CEO of Zilch. It's Europe's fastest growing fintech company to go from Series A to unicorn status in just 14 months. Self-professed growth. And I'm interested at this time that what has been your business model? And I know it's of consumer credit, basically reducing costs. How has that managed to see that growth in what has been a much tougher time for tech more broadly, Phil?
Yeah, I think what's interesting to note here is that the landscape, which if I kind of paint the picture a little bit, it'll explain why we're seeing this disproportionate growth to the rest of the market. And that is that the landscape today is that we have high cost of capital. What that typically means is that your high street lenders, your banks tend to actually withdraw themselves from lending. So you have financial exclusion at its highest. So the demand goes crazy for credit products. At the same time, you have the cost of living has gone up. And so you have demand from the mass market is really intense for credit products. And typically what happens is you have lenders actually thrive in a market like this, but they make a lot of money off the customer. What's unique about Zilch is that we found a way to generate ad revenue from brands when our customers shop. And we're using that to offset the cost of credit to customers while servicing this mega demand. So for us, we're seeing ultra high growth through the next year to 2 years based on all of this coming together, of course, most uniquely providing lots of savings. We're talking about hundreds of millions in savings in interest and fees for consumers as they use our product and move away from traditional lending products like revolving credit cards and things like this. So there's the opportunity.
They can improve a credit score, not have to depend on credit cards. I'm interested, Philip, as a South African entrepreneur, to come and build in London. Why?
I mean, I think it's part of why there's the Tech Summit tomorrow. There's a lot going on in London. Obviously, we look at the market here and say, we really wanted a hub that was going to allow us access to Europe, of course, to the United States.
And you've still got access to Europe?
And we still do. I mean, a lot of people, of course, have spoken about Brexit and what does that change. The reality of the situation is that you just need to make sure your licensing is correct and you understand how to operate in that environment. Regulation, by the way, as long as it's clear, is a fantastic thing. We've also said this for our industry, which is why Zilch is one of the only regulated providers in the space. We're calling for regulation in BNPL. And so I'd make this comment in the vein that you've just mentioned. As long as the rules are clear, you can engage with those rules and you can transact. And so we do have access to Europe. We understand Europe very well from the United Kingdom and equally the United States, which is a massive opportunity for us. So we really wanted to be in London. We think we can control what we're doing from here really well. Great, unique pool of talent, lots of walks of life and different types of backgrounds in our business. And we really wanted that diversity in the company as we built this mass-aspirational product, something we want everyone to enjoy.
Mass aspirational. Philip, what about those that you woo in for money? You just said, of course, you're now viewed as a unicorn. Money has been allocated from venture capital. Is that pool of money UK-based? And is it firm at this moment when people are questioning those sorts of valuations?
I think it just depends on the business. I mean, we've seen a lot of companies raising flat rounds, up rounds. You've also seen, of course, down rounds. There's been an adjustment. There's no doubt about that. The way we think about it ourselves is, do you have enough capital and do you have a sustainable business model to get yourself to break even and beyond right now in this market? I think that's how we see at least our company. And you know, the strong view is, as long as you can demonstrate that, and that is the case, you're probably quite a standout business right now. And that's not because there's a lot of terrible businesses. It's just because a lot of money was chasing high yield. They wanted growth at all cost. And the problem with that is they sacrificed the margin and a real business model in some cases for that. And the chickens are coming home to roost. If you have a real profitable margin, and you've got enough capital to get to break even or beyond, we still think that you can demonstrate the real value in your company, and you can grow in and beyond your valuation. And that's really how we're thinking about our business. So pools of capital wise, I mean, I think in the UK we sometimes underestimate second deepest pools of capital on this planet are in the United Kingdom. But we certainly do see in our business a spread of capital from the US and the UK. And that begs the question, where do you go next? What do you do next as a company, which we're evaluating right now?
Ooh, okay. Leaving on the idea that we're seeing some raising of funds from Philip Bellamont of Zilch. He'll be at the Bloomberg Technology Summit tomorrow. We thank him very much for joining. And we'll be talking about that wealth of money coming from various pools later in the show, whether it's, of course, VCs. We've got Emily Heath, general partner over at cybersecurity VC firm Cyberstars, joining us as she wants to discuss some of the trends she's seeing across the sector. And meanwhile, let's just get into the public markets for a moment as well. Let's tune into what's happening with the shares of Airbnb. Again, a rally on our hands, a bounce back from what has been some questions regarding regulation. We're just talking a lot about financial, fintech regulation there. And certainly in New York, Airbnb has been a focus in terms of regulatory pushback. We're currently, though, up almost 4%. From New York, usually. From San Francisco, usually. From London today, this is Bloomberg Technology. Look, we'd be remiss if we weren't thinking about some of the geopolitical situation that we currently live within. And it's notable that in the concerns around conflict in the Middle East, government and private companies are looking to continue to beef up their cybersecurity. And cyber startups are turning to venture capital firms like Cyberstars for backing. So far, its portfolio is valued at more than $30 billion. Joining us now from London is Emily Heath, general partner at Cyberstars. It is wonderful to have some time with you. And Emily, you're British originally.
Yes, I am.
And now based in SF. You have worked for a whole host of companies across industries such as airlines, but you've been, of course, DocuSign being a key company, that you were Chief Information Security Officer. Now you're using your expertise to allocate capital.
Yes.
Why at Cyberstars?
Cyberstars has a very, very unique model. We're a very small but mighty cyber-only venture capital firm. And there's a secret sauce behind this firm. They're very small. There's 3 partners, 2 in Tel Aviv and me in San Francisco. And we each bring something very, very different. We've got entrepreneurs, we've got traditional venture capitalists, and myself being the practitioner. So when you think about bringing the operational experience to young founders that are in the very early seed stages, we forget sometimes as practitioners how much value we can actually add to these young companies to make sure that we stress test the problem statements that they have and make sure that they're building long-lasting, meaningful companies.
Founded in 2018 by a Sequoia partner, but also the godfather of the Israeli cybersecurity scene. Israeli. Just talk to us at the moment about how you are seeing the ecosystem affected there. You must have, of course, a large amount of portfolio companies based there.
Yes, in fact, every one of our portfolio companies is based in Israel, and there's a sadness. I mean, there's an absolute profound sadness amongst the community right now. And on a personal level, I don't think I've met a single founder that hasn't been affected in some way, whether they know somebody who has been murdered, somebody that's missing, or somebody that's been profoundly affected. So on a personal level, it's struck really, really close to home for us. On a professional level, however, I am so impressed with the resilience of the Israeli people and of the Israeli startup community. It is absolutely incredible. I think this concept of business continuity and resilience is something that we talk about all the time. Israelis have this natural ability to think about what that actually means because they're used to living in turmoil. This is, of course, unprecedented. But what it means is they were prepared and able to bounce back. Now, some of the portfolio companies have had some of their staff that are now on reserve duty. There's people in the United States that are standing in for them, but business has remained relatively unaffected. I would not say it's business as usual by any stretch, but these are resilient people who really truly have continuity plans that have gone into effect.
Geopolitics is complex. So too is the world in which you work of cybersecurity. And I'm wondering what, therefore, problems they are generally trying to tackle, what ways in which you're seeing your startups, your portfolios, manage to outperform it in a market context that has been very difficult.
Well, it's all about the people. I mean, our philosophy first is we invest in people. Most of the companies that we invest in haven't written a single line of code when we give them seed funding. So as I said earlier, they stress test the problem. One of our main portfolio companies, a unicorn called Wiz, fastest growing software company on the planet ever, faster than Twitter, Airbnb,
How
Facebook.
are you measuring that?
Based on growth, so they've been around for 3 years, $10 billion valuation and over $300 million in revenue in just 3 years. So just the trajectory of the growth. Because these founders, they're second-time founders, so they've been there and done it before, and that definitely helps. They listen to the market and have adjusted to the market very easily during times which are very tumultuous. And again, we want to make sure we're solving very real problems.
Yeah. Emily, we're going to talk about some of those challenges and opportunities a little bit more, of course. She's going to be attending the Bloomberg Technology Summit tomorrow. Emily Heath is general partner at Cyberstars. And look, we're going to be discussing a little bit coming up on the LP side of the equation, pension funds. How are reforms here in the UK going to change the game? This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in London today and for the next few days. Meanwhile, let's get a quick check on the markets that are trading worldwide for you because it has been a volatile day with yields on the higher side, but they actually have pulled back now. We're down some 6 basis points on the 10-year, having eclipsed 5%, of course, higher since more than a decade, 2 decades. We're now pulling back to 4.85 on the 10-year. That leaves some breathing room on the growthier names. Nasdaq 100 manages to rally on the day up some 0.8% as we anticipate some key earnings coming from Microsoft, from Alphabet, after the bell, of course, looking at that tomorrow. I'm looking at New York crude, though, still off by 2%, but elevated. We're at $86. Of course, this is in a geopolitical context where we are awaiting whether or not, indeed, the conflict between Israel and Hamas is indeed escalated in any way. For now, we damp down some of those concerns. Move on to what is, of course, a key risk asset of choice when it comes to technology. Bitcoin, it has been on a run. We're up almost 3.3%, 30,000 in excess of that now, a key technical level. And, of course, as many anticipate, perhaps the SEC, it pulled back from its cases versus Ripple. Are we looking towards some sort of ETF in the future? Is it indeed some sort of, haven? That's a key question. Meanwhile, we want to talk a little bit more about some private markets, an allocation of funds here in the UK. Some of Britain's largest pension firms have committed to allocating a minimum of 5% of defined contribution funds to unlisted equities by 2030. So think startups. The aim is to unlock over perhaps £50 billion of new capital by the end of the decade. Joining us now is someone who's spearheading this entire movement. Nicholas Lyons is the Lord Mayor of the City of London, where you oversee basically the economy of the square mile. You try and anticipate the ways in which we can make it thrive. And one way is you think allocate pension funds, of which you come from, Phoenix Group, a pension focus. Why startups? Why is that a benefit?
Well, look, the starting point about pensions is to get the best returns for pension savers. And that, we must never move away from that as a fundamental underpin here. The most successful pension funds in the world, usually the Canadian state pension funds, the Aussie Supers, have between 30 and 50% of assets invested in unlisted asset classes of infrastructure, real estate, private credit, and private equity. So we need to get the pension system in the UK, of which there's over £4 trillion, more invested in productive assets to give better returns for pension savers. The reason that I particularly focused on late-stage venture capital is, as you've heard earlier, there is good incubator and seed capital in the UK, but often are high-growth companies, and we are brilliant at these high-growth industries of tech, fintech, green and renewable tech, clean tech, biotech, life sciences. We've got 4 of the best 10 universities in the world, 7 of the best 20 universities in the world. But too many of these companies, once they've sort of proved their business model and are looking for accelerator financing, have to go externally for capital. And I want us to marry up that need with an opportunity to get the best returns for our UK pension savers. Why should, I mean, we love Ontario teachers' pensions, but why should Canadian teachers be benefiting from the incredible entrepreneurial spirit in the UK?
So it's about allocating British pensioners' funds or future pensioners' funds to a UK ecosystem as well, because will they not therefore be able to access private markets outside of the United Kingdom?
They will, absolutely. And I think the idea here is that it's not just the what about allocating 5% of DC pension funds, which, you know, we think by 2030, just because DC pensions are growing by 10% per annum, we're going to have between £1 trillion and £1.3 trillion in DC pensions. So 5% is about £50 billion. I'd like a significant chunk of that to be allocated to a future growth fund, which has the advantage as a collective investment fund of being able to get the enormous diversification of risk that actually you need when you're talking about companies at that early stage.
Can you give us a context as to why the UK has been reticent psychologically, culturally, to invest in that way from its pensions funds?
I think it's a combination of things. Part of it is cultural. I think since 2008, we've been pretty risk averse as a financial ecosystem. The regulators have been given a primary objective of making sure we didn't have a repeat of that, and we looked after customers' interests. Quite right, but we need to give them, and we have now given them, a secondary objective of competitiveness and growth, so they have another lens through which to look at these things. But I think one of the biggest issues is that we've not had that sort of culture, particularly, of investing in late-stage venture capital. And North America has really stolen a march on us in that regard. So we get a lot of our companies getting on a plane, going to the West Coast, and looking to raise money over there. And they can continue to do that, and they should continue to do that. We should still get lots of international capital coming into the UK, but I want us to get some UK money working too. 50 billion is a good start.
It's interesting that, of course, this comes hot on the heels of Arm, a UK-based company listing in the US for deeper capital reasons. Also, in a global context of the technology sector having been pretty hard hit in the rise of yields, borrowing costs going higher, growthier names have been hurt unless you're AI focused in some way. What has been the conversations like with the pension industry, of which you're somewhat a part? We're not on sort of loan to the City of London. What have they been like? Where's the reticence been in this context?
There hasn't really been much reticence. 9 of the largest players, representing 65% of the DC market, have been supportive of this and signed the Mansion House Compact in early July, when the Chancellor was at Mansion House and was able to announce this. So I think there are very big players like Aviva, L&G, M&G, who've got big asset management capability, including in the private equity sector, who would like to say, well, yeah, we're happy to sign the Mansion House Compact, but we think we can do that ourselves. There are lots of others, because we have a very, very, broadly diversified pension system with lots of small players. They need a collective investment fund that they can use as the vehicle through which to invest in this asset class. But I think by creating a £50 billion war chest, if you like, and with much of this going into a future growth fund, we'll be able to change the culture. We'll be able to develop a real ecosystem, it's not just about capital, it's about making sure that we've got really strong non-executive directors and mentors who can help these companies, and also improve the equity research that we write on tech companies. I'd say there's actually a significant differential at the moment in the quality of tech research that happens in the US and in the UK. So this is not just a silver bullet. We've got to change the culture, and there's a lot of work that's involved in this.
Note to the sell side. I'm interested, just to end it, Lord Mayor, on the idea of whether this money automatically goes to British-based venture capital companies, or are we going to suddenly see a flock of SF-based funds come in and want to make the most of this pool of capital?
I think we, again, if you come back to this this first mover, which is that we have the desire to deliver the very best possible returns for pension savers. Therefore, we need to make sure that they have a diverse and not just UK, but also international exposure too. But we have got such good companies. The fact of it is, the most sophisticated investors in the world come here to invest in the best of British. So let's invest alongside those sophisticated investors and deliver great returns to pension savers and get some of these companies listing in the UK. In 5 years' time, if we're successful with the Mansion House Compact and what we're doing with DC pensions, we'll have £5 billion, £10 billion, £20 billion tech companies in the FTSE 100.
Not just a Deliveroo, Nicholas Lyons. We thank you so much for joining us. The Lord Mayor of the City of London, ahead of what is a big event that they'll be throwing on Wednesday. Coming up, in fact, we're going to be talking with a key venture capitalist who does allocate money into the UK and Europe more broadly. Our VC Spotlight time is upon us, and we're going to be talking about the tech scene in here in London with Harry Nellis of Accel Partners. From London today, we're going to be watching the shares of certain companies related to crypto. We're just showing how Bitcoin is outperforming for a variety of reasons. Well, a lot of the key names that are, of course, invested in the crypto space, whether it be Riot Platforms, for example, currently up 11% on the day, one of the key outperformers. From London, this is Bloomberg Technology. For talking tech, first up, Apple is hoping to incorporate artificial intelligence into some of its key services. Think Siri, of course, the App Store as well, Apple Music. In fact, Bloomberg's Mark Gurman says Apple is exploring new features such as auto-generated playlists, other LLM functions similar to those already found in Spotify or Microsoft Office. Meanwhile, venture capital firm Peak 15 Partners, of course, previously Sequoia Capital in India, says AI startups are dominating its accelerator program. Peak 15, and indeed it was present in Southeast Asia as well, says that 10 of the 13 startups in its cohort are in the AI and deep tech field. The VC firm has invested as much as $3 million in capital to startups thus far. Plus, Microsoft will invest roughly $3.2 billion to grow its Australian data centers. The US tech company plans to expand its cloud computing and AI infrastructure over the next couple of years. Its largest investment to the country in 40 years, in fact. Australian Prime Minister Sir Anthony Albanese is currently on a 4-day visit to the United States. Oh, there's lots of billions and millions being thrown around. Let's do a little bit more in our venture capital scene here in London. Accel has been on the ground in Europe for 23 years, opening its London office all the way back in the year 2000. And the firm has made investments in some of the key standout names that have outperformed. You know, Spotify, Supercell, Deliveroo. Accel partner Harry Nellis is now joining us to discuss an evolution, an ecosystem that has exited founders, has money that gets reinvested into the tech scene. Does it get reinvested here in Europe? Do founders leave the likes of Spotify, Deliveroo to go and build their own companies?
Absolutely. We recently did a study and it showed that 200 unicorns in Europe have in fact generated 1,200 new startup companies. And that is critical for the ecosystem because for an ecosystem you need capital, entrepreneurs, but also repeat management teams. And that is finally now starting to happen, which was very different from 23 years ago when the market was very, very early.
Yeah, and it took a while to build such unicorns. I mean, when you say that there have been more than 200, I think it's exactly 221 unicorns in the region, people might be slightly surprised by that, do you think? I mean, what key areas have we seen billion-dollar companies founded here in Europe?
Yeah, well, it was our conviction 23 years ago that it was indeed possible for Europe to generate these billion-dollar outcomes. Our investors doubted it at the time. In fact, we had to wait 5 years for that first unicorn to show up, and then 3 more years for the second one to show up.
What was the first one, do you remember?
The first one was Skype.
Of course.
And then MySQL in 2008. So the big sectors that have generated is online games, Supercell, enterprise software, ClickTech, consumer technologies, including Skype, so a variety of things, in fact, which is one of the things that characterized that very early market. You couldn't really specialize in anything. You had to be very broad because innovation happened across the board, but at very shallow layers. There weren't many companies of the same type.
It's interesting, of course, of Skype was Nicholas Zenstrom, who's gone on to found his own VC when you think of Atomico. And I'm interested in, like, that was early days sort of artificial intelligence before AI was cool to be saying in every single lexicon. But what are you seeing in terms of AI proficiency here? We're about to have an AI summit about the regulation, the safety. Is there key AI expertise and businesses being built here in Europe?
Absolutely. There's many universities across Europe that have generated very interesting founders and deep technology insights into artificial intelligence. We've been funding a number of those. And artificial intelligence is really impacting a number of the themes that we're investing in already. Enterprise automation with artificial intelligence, you can actually improve that. Cybersecurity, powered by artificial intelligence, you can actually make that better. So we see artificial intelligence as a major paradigm shift, a new platform, if you will, after many of the others. So we had the internet, we had mobile, we had cloud computing, now we have AI.
Why then, let's play the cynic and the counter to this narrative of one that is optimistic. Why then do you think there is this worry about post-Brexit, London not being an ecosystem for Europe? Why then do you think perhaps in a current market cycle that's been very difficult, we're not getting companies raising their funds in Europe, instead arms going to the US for the deep pockets?
Yeah, I think we've gone through a very strange period during COVID where there was an enormous amount of capital available and enterprises actually overbought software. That is now over. So we're going through this transition period where people are trying to find a new price at which deals will be done. And the reality is that many software companies and other tech businesses just had so much money that they didn't have to raise more money. So we're now entering a stage where they are running out of money, we think, in the year to come. They will have to raise more money, and then we'll discover where that price is.
Does that mean, and we actually had, for example, Anu Dougal, she's of the Female Founders Fund in New York, saying that there's going to be about 1,000 unicorns that are going to have the rubber hit the road. They're going to run out of money and likely won't find new funding. Do you think that we will see an awful lot of unicorns suddenly exploding?
No, I don't think so.
Not unicorns?
I mean, there's $200 billion of dry capital on the sidelines waiting for market discovery of new prices. So I think there's plenty of money available for unicorns. I think it will be an environment in which flat is the new up. So if you can raise money now at the price where you raised money 3 years ago, that will be victory. In fact, in the subsector of software, we did a study, and of the 200 unicorns in software, only 10% of them actually had to do a financing, and half of those actually financed at flat or up prices, and only a fraction of them down. So I don't think it's going to be that bad.
What about more international funds, such as yourself? You allocate money around the world. Accel is a worldwide known name. Are more international VCs, West Coast-based VCs, those in emerging markets, are they coming here to Europe?
Yeah, absolutely, because Europe has become a really interesting market. What we saw 20 years ago, most people are seeing now. Namely, Europe is innovation happens everywhere, including Europe. It's a great market to be at. It's a great advantage for us to have been here for so long, but many of our competitors are now here as well, which is good, because you cannot have an ecosystem with only a few investors.
What does this ecosystem seem like, look like, sound like from a diversity perspective? How does Europe, for example, compare with Silicon Valley, where people are always wringing their hands, and rightly so, that there is a lack of diversity in founders and indeed the VCs that allocate to them?
I think Europe is no different from the US. It's very similar in that sense.
So underrepresented, can do better.
Yeah.
How are you seeing it try to do better?
I think everybody is making a concerted effort in order to get it into the right direction. But it also has a lot to do with what happens before we meet entrepreneurs, like education, primary education, college education. That all adds up to the people whom we end up seeing as entrepreneurs.
So fix it in several steps before as well. Harry Nance, it's great to have some time with you. Thank you for joining here in London, of course. He is of Accel and a key VC here in the UK space. Now, the film version of Taylor Swift's Stadium Tour held onto the box office lead for a second straight weekend. Outdrawing a new Martin Scorsese drama from Apple, of course, Taylor Swift, the Aries Tour, brought in $31 million in North American ticket sales, while Killers of the Flower Moon, first ever big screen release from Apple Original Films, it opened to sales of $23 million. Meanwhile, sticking with the film industry, look, we've got to be talking about the Hollywood studios and the SAG-AFTRA Actors Union apparently resuming negotiations tomorrow, more than a week after suspending talks aimed at resolving a months-long labor dispute. Joining us now is Bloomberg's Felix Gillette, who, we must think through some of the sticking points. What is the stumbling blocks still remaining for the actors when the writers have moved on?
It's mainly two things that are remaining. One is the compensation from the streaming services and how that will go to actors, and two is protections from artificial intelligence.
Okay, a lot of the AI concerns, for example, have been held by smaller acting positions, bit parts and the like. But now we see big actors coming and weighing in to try and push on those studios. How are you seeing George Clooney's voice and others added to the arena, Scarlett Johansson and the like?
Yeah, I think that's just evidence of the mounting frustration in Hollywood. I think there was a lot of hope that when the writers reached an agreement a month ago with the studios, that the actors would be able to take that template and follow quickly. But that's been a month now. It hasn't happened. So, last week you saw George Clooney and a bunch of other A-list Hollywood actors jump in, set up this Zoom call with the union leadership, toss around a bunch of ideas, hoping maybe that would resolve things. It seemed to have done nothing. I think the consensus was that their ideas weren't going to move the needle enough.
It was interesting that some of the bigwigs on the other side of the equation, so Donna Langley of NBC, or whether it be Bob Iger himself at Disney, they got round the table with the writers. Do you think the same thing's happening here with actors?
Yeah, I think they're involved. I think, again, the main problem is that the union has this idea of, initially they proposed taking the percentage of all streaming revenues. I think it was 2%, then 1%. Then they came back with this idea, okay, we're not going to take a percentage. We'd like an assessment per subscriber. And, I think the top studio bosses, including people like Ted Sarandos and Netflix, have said that's a bridge too far. It feels like a tax. We're not going to do that. And that was really the last thing that broke off negotiations.
Well, we'll see how they reform tomorrow. Felix Gillette, great to have your perspective on it. We thank you. Meanwhile, that does it for this edition of Bloomberg Technology. Do not forget to check out our podcast and tune in tomorrow because we've got the big event, Bloomberg Technology Summit.